Okay, so today I wanted to go over the type of loans, especially if you are a first home buyer. I think it's really important that you should know what kind of loan that you should get and how they work, right? So you have fixed rate and you have adjustable. Fixed rate is whatever rate the lender gives you is never going to change. It's always going to stay that same rate. Let's say if you qualify for a 2.8, 2.8 is going to stay for the term. Whether it's 15, 30 years, 5 years, doesn't matter. Adjustable rates, it's based on the market. Let's say right now, rates are very good, and if you believe that rates are going to stay very good until next year or they're going to go even lower, you can do adjustable rates, which means it's always going to change by itself. Okay? So the most three common loans that are used here in Michigan that I've seen are FHA, which is the Federal Housing Administration, conventional, and VA, which is the Veteran Administration. All right? The difference between the three types that I just mentioned right now is FHA is backed up by the federal government. It's already, it requires 3.5% down, and it does have a PMI, and that PMI will cover 100% of the loan if you default. So if you stop paying your mortgage and they foreclose you, that insurance, the PMI insurance, will cover 100% of the loan. Now, same thing with VA. The only difference between VA and FHA is the veteran loans, you don't have to put a down payment. So it's a zero down payment. But there is some VA, fees that you have to put up, which can go up to 2% of the loan. So it really depends on the lender and who you apply through and your credit and income. So they all do have almost the same requirements. For FHA and VA, you need 640 credit to qualify at least. Some lenders, they require 650, some 670. Really depends on the lender, but the most common I've seen from experience is 640 credit, 2 years of history, no gaps with those 2 years of history. Let's say if you've been working for a year and a half and you have been off for 5 months, you need to go back to work for at least another 5 months. And I know for sure some lenders are very picky when it comes to the profession, right? They want you to stay in the same profession. Let's say if you're a nurse, you quit and you became a pharmacist, that's still in the healthcare industry. So that's still in the same profession. So that would be fine. But let's say if you're a nurse and you change to, a restaurant manager or owner, that's a whole different profession. So that would be a problem. So that's something to also look into. Now, there is another type of loan that I have not seen used, and I think it's because of the area, but it's the USDA. I believe it's funded through the Department of Agriculture. So it really has to do with the location where you at. But that loan also is almost like a VA. It's a zero down payment, up to 1% for the loan fees. Now, if you pay 20% with conventional, you don't have to pay a PMI. Same thing with FHA. It's up to 20%. But conventional, unlike VA or FHA, that PMI only protects 70% of that loan. So that's how much you would be responsible for.